self-storage really parallels multifamily. When you see multifamily going up, you see a self-storage facility that's either already in the market or going up right behind it. The numbers, this is a predictable business model. 1 in 10 households rents one or more self-storage units. Equilibrium is 6 to 8 square feet per capita. So we look at those metrics when we develop or we're buying and looking to expand a facility. And so we're always looking at those micro markets within a larger market.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. How we doing, bud?
Oh, we're doing good. We are. I'm going to flip the script, as normally I would say complaining, but I was just talking to Chris offline. We had a really good podcast coming out, and I will leave it at rent growth is real, and there are real markets in this country that are, I don't care, economic situation or not. I just feel so strong. All asset classes, but there are just some markets in this country that just have runway, right? And I know we've been on a crazy bull run, but there's exciting stuff happening. And coming out of Memorial Day weekend, we're in June, and it's just exciting. I think there's going to be some real opportunities for people to make some money across all asset classes. I don't care if they're 18. 12 or 200, right? No matter, there's going to be opportunities in the future, even if you think the pricing doesn't make sense today, but I will leave it at that.
Yeah, no, it sometimes feels like, valuations are skyrocketing, and how does a deal that sold for 50 a door 3 years ago trade for 100 a door? But I don't know, rents keep going up, people keep moving to areas. So if you're in the right areas, you just got to adjust with the times. But yeah, rent growth is crazy. Population growth is crazy. I can tell you, being in Jacksonville, Florida, is just, every day, every single day, every week, every month, it just keeps going up and more people keep coming. So it's pretty interesting to see and, be in it every single day. So it's sometimes tough when you're out of state, like not being there all the time, but making that transition, it's pretty eye-opening. There's just a lot of people and everyone knows it. And, it's just everyone, it's just everywhere.
So that's the thing that I think has been very challenging, sitting here in New York, and even I've been vocal about this, coming out of what I used to do to what I do now. Not being in a market is a lot harder to understand the market than being there. And when you talk to people that live in Jacksonville, Austin, in these major metros, Nashville, and these areas that are experiencing such population growth, you guys see it firsthand, where we sit back and people are leaving New York and they're getting out of here and they don't want to be here. So you get skewed a little bit, like, okay, how do I go about buying a deal in a market where I'm in a market where it's just, the housing market's crazy everywhere, but where you see so many people leaving, you're like, okay, is it skewing your perception on the deal that you're buying? So I think that there's definitely that component to it, but you're right. I mean, you live, see, and eat. I mean, you probably speak to 100 people a day, 100 people a month, and probably 85% of them are 85% of the people you talk to are probably relocating or moving or coming down there, and you're seeing it firsthand. So it's exciting. Like you said, I just think there's just some great growth. I mean, states are opening up June 1st, coming up here shortly. There's going to be a lot more openings. I think the tunnel, the light at the end of the tunnel, we're very close to it, or if not there. So I think it's going to be exciting to see how this thing plays itself out.
100%. Couldn't agree more. But let's jump into today's episode. We got a really great guest on today. Excited to hear his story, learn from him, and get his opinions on things. So with that being said, Scott, thank you so much for joining us.
Chris, John, thanks. Good to be here.
Yeah, absolutely. So kick us off. Tell everybody a little bit about you, your background, journey, what you do, all that good stuff.
Sure. Well, 100% in the self-storage business, but did not start out that way like many folks when I got into real estate. Of course, this is a ways back. This is 1993. I bought my first single-family house using the Carlton Sheets home study program and methods for some of the folks that have been out there for a while. Buying a house, and actually bought it with believe it or not, a VA loan that I was able to assume at the time. So we rehabbed it, refinanced it, rented it out. So the Burr method before it was called the Burr method. And then we took that money, those proceeds, and bought two more just like it, also on VA assumable mortgages. And so protecting our credit in the meantime. And then we just continued to do that up until we had, I think, 18, 19 houses, and didn't have quite the free time and the excess cash flow that Mr. Carlton Sheets had talked about. And so I thought, well, I just need to get some economies of scale. That'll fix the problem. And so we started buying apartments. So buying just small to anywhere from 18 to 70 unit apartment complexes in and around central Indiana where I live. And then found several years later that all they did was really kind of complicate and multiply the challenges that we had on the tenant toilet side of the business, and realized that I wasn't cut out to be a landlord, and didn't like being the property manager of our own tenants too much. And so didn't want to get out of real estate because, this is the best investment, period. I mean, there isn't anything out there where we can borrow money to buy an investment. You can depreciate it. It appreciates if you do the right thing, and then you put tenants in it to pay down your basis. I mean, there's nothing that beats it. But if I don't like tenants and toilets, then that leaves me with parking lots and self-storage. So I began to look into self-storage because you can't really build a lot of value into parking lots. And the more I looked into the business model, the more I liked what I saw. So if somebody doesn't pay with a self-storage facility, then you lock them out. It's called an overlock situation. And then after 90 days, you sell their stuff off and you recoup your money. Which sure beat going to court when trying to evict a tenant and getting a little yellow or pink piece of paper and not being able to collect on that most times. And our average turn in our apartments was about 3 to 4 weeks from front to back, and cost us about $1,800 to $2,000 to paint, repair, replace carpet, clean carpet. And then the downtime of not gaining income, where in self-storage, once somebody moves out or after you auction them out, we take a blower, a gas-powered blower, in 30 seconds or less. We blow out the concrete floor and move in the next person that's waiting in line. So once I began to look into the business model, I thought, I think I'm going to take a shot at this, and bought my first self-storage facility with a partner. It was a divorce situation, a business divorce situation. Two partners didn't get along, and we stepped into some equity and a great facility with room for rent growth and an opportunity to expand and build additional buildings. And so that's how we create the value, and that's how you build value in these facilities, along with rent growth and adding some ancillary income streams. And after that saw the light, we sold off all our rental houses and apartments, and now we invest in nothing but self-storage. So we're sitting at approximately what we've purchased, developed, or converted over 2.4 million square feet, approaching 14,000 doors nationwide now. And along the way, we also created an education company and a publishing company where we teach people how to do this business as well. We consult with them, a number of services that we offer, which affords us the opportunity to partner with folks along the way. So there's the 5 to 7 minute version of where we've been and where we are and find ourselves today.
Mm-hmm. Perfect. So, John and I were just talking about rent growth and population growth and stuff like that. I think it'd be cool to hear your version of that. What has it been like? I think COVID probably kicked up or accelerated a trend that was already happening. Do you guys similar things happening in your space, and how has it affected what you guys have done over the several years, if not decades, of being in the business?
Yeah, so this will be our third go around. And when I say go around, meaning a recession, obviously first pandemic. I don't think anybody of us have been through the last one. But being in storage, we're truly, as the saying goes, we're in the trauma and transition business. And so when people have trauma, when their basement floods, when they're if they have to settle an estate from a loved one that's passed away, somebody is getting divorced or doing something they shouldn't do, they get kicked out of the house, there's a demand for storage. And then transition, as you mentioned, when people are getting ready to move, the realtor comes over and they tell them to get rid of all their kids' plastic toys and everything else that makes the house look crowded, and stage the home. Everything goes to storage. And then when they move, there's either a greater need, or depending upon where they're moving, a need for another unit from that standpoint. So springtime is always busy for us, but most of those people, they think, well, I'm just going to rent a unit for a month or two, and they stay for a year or 20 years longer after they find out how good it is to have a unit. So the pandemic added an extra twist to all of this. When the colleges closed immediately, all the kids put their stuff in storage, and instead of doing it in the town in which college is located, and they just brought it all back home and put it in storage. when businesses shut down, which many of them did, tens of thousands across the country. Those companies that either gave up a lease or gave up a building, unfortunately, they put their inventory and their business into a storage unit until things turn back around. And then we had everybody leaving office buildings during lockdown. And those workers had to come home and find a place at home, whether it be in the kitchen or dining room or living room, to set up an office. And sometimes it was one or two wage earners. And so they had to move furniture out and make room to build an office and work from home. And so that created an even greater demand for storage. And then the third piece, or the fourth piece to that then, is what we have during a normal recession and or joblessness, which is a whole lot of people that are moving in with one another, moving back home. And so, their goods, most of their goods are put in storage until things turn back around again for them. So all of those, whether the economy is going very well, and people are moving into houses, buying houses, that's always good. And people buying more stuff, they don't have room for it. But then also when the economy takes a dip, as we've seen during recession, that's when storage really benefits even more. We see the hockey stick effect during a recession even more so. And we weren't affected. Storage is it is an essential business. And so we may have been shut down depending upon the state. Unfortunately, John, in New York, storage was shut down a little bit longer. And so was the construction of some of our facilities. But the rest of the country, it was a pretty short blip before then everything and everybody was open. And we've had the ability to, rent units on a cell phone for years now. The technology has been in place that we don't have to come into contact with an individual to rent a unit. So, we've been touchless before it was cool to be touchless in our industry. And so a long-winded answer to your question, but we don't celebrate recessions, and we certainly don't celebrate a pandemic, but we are enjoying the gift that the market has given us during this time.
So I was going to say, so yes, obviously taken out of context, this could sound bad, but when you saw what was happening from an investment perspective, you're sort of licking your chops a little bit because you guys are going to thrive. Now, from the mental health and losing people, that stuff's horrible. I don't care how rich you're going to get. It's a horrible thing, and everybody probably sees that, at least 99% of the people. But from an investment perspective, when this was going on, you guys probably sat back and said, we're going to have a great quarter or a half a year, or, we didn't think it would be this long. But so this was a very good time for you guys.
It was. And again, we've known, in economic cycles, in 7 to 10 years, we go through a recession, and I've been through this again. This will be my third, and we know what storage does during those times. And so, we've been anticipating that. And of course, we kept waiting and waiting and waiting. The last administration somehow kept things going along so that we never had that recession. But then the pandemic hit. And then once again, we went off a cliff like we did in 2008. And so, yes, I guess if you would call it quietly celebrating, but again, we don't celebrate these terms, but no, we have benefited greatly, and we knew that this is our time. And we've been amassing a lot of cash since the last one, and, increasing our Rolodex of lenders, just knowing that, once this happens, we know what, the opportunity that exists. And so we've been waiting for it.
So when self-storage is a super intriguing space. I know my grandfather 35 years ago probably spoke about it. Even before I was born, he said he always wanted to do it. He did some other stuff, which was extremely successful. But from a standpoint of, someone listening gets intrigued by self-storage, with population growth, as we were talking about earlier, and migration and stuff like that, are there opportunities, or where do you guys see the opportunities? Not like everyone's zigging, you want to zag, right? Where can the differentiator be for someone listening, saying, okay, self-storage is intriguing. I don't have millions of dollars. I have $500,000 and I want to go buy myself something different. Where do you see that lie in the landscape that's in front of us?
And we get that question a lot, John. And I wish there was a very succinct answer that I can give someone that doesn't sound like I'm real wishy-washy or like I don't know what I'm talking about. But at the end of the day, the grass is always greener, and everybody wants to know what's the hottest market. I mean, peel back the curtain to your question. Where should I be going right now? Where should I be looking? And growth is always good. Jacksonville, Chris, I mean, come on, that's, growth is good. It creates a demand for storage. And you'll see, self-storage really parallels multifamily. When you see multifamily going up, you see a self-storage facility that's either already in the market or going up right behind it. The numbers, this is a predictable business model. 1 in 10 households rents 1 or more self-storage units. Equilibrium is 6 to 8 square feet per capita. So we look at those metrics when we develop or we're buying and looking to expand a facility. And so we're always looking at those micro markets within a larger market. But from a macro sense, and here's the wishy-washy part. Growth is great. We want to be in the growing markets and we want to buy the land a little less expensive. So we want to be on the outskirts of the cusp, or where, the pipes are coming, if you will, and where the development is happening. But also realize, again, we're in the trauma and transition business. So those areas that are struggling a little bit, if there is a downturn in the economy or people moving out, that is also usually a great market for self-storage. Now, population goes off the cliff like we've seen over the past several years, and cities in Michigan like Flint and Detroit, and then also down in New Orleans, parts of New Orleans, when the hurricane went through and Katrina and wiped out some neighborhoods. That can be catastrophic for a particular self-storage facility or facilities in some of those areas. But by and large, we look at our market is truly a 5-mile radius is what we're looking at in terms of population and the amount of supply or our existing competition, and then the rental rates. And we run our numbers and our pro formas based upon that. So to cast a broad brushstroke and say Jacksonville is the greatest market out there, some may say, well, it's overbuilt. We're seeing these things go up all the time. Or Austin is an incredible market because it's growing, but oh gosh, it's overbuilt. We see these facilities going up, and we see areas in which they're slashing rates. You can't paint a broad brush stroke over any one particular MSA and say that it's either good or bad, because we have these micro markets. And you also can't say if people are moving out of a particular market and there's a slight dip in population, then that's bad for any development or all asset classes, because self-storage benefits from that as well. So again, long-winded answer to your question, and not an easy answer to it, but those are the metrics that we look at. So we are very opportunistic in looking at all markets.
So then how do you look at those markets, the sub-markets, basically, when you have, so many markets across the country, and it sounds like, you're looking for pretty specific criteria: number of people, number of supply, number of square foot per person, things like that. How do you sort through all this data to find areas that you think are undersupplied or could use new development or something like that?
Well, so for the beginning investor who's intrigued and wants to get into storage, they need to look in their backyard and begin to look at areas in which the supply is low, meaning that everybody's full and they can't get a unit. And rental rates are rising, and that comes from direct mail to sellers and or calling around to find out what that looks like. And there's a number of other ways, obviously, to find what that looks like. But if you're sitting back and again, on a macro sense, and trying to pick a market throughout the country to invest in, that may be a little more difficult. You need to do that in a market in which you probably have some boots on the ground, or you're already investing yourself and can go out there and do the due diligence. Create those relationships with the brokers, again, doing direct mailing to owners to flesh out facilities that may be for sale or coming up for sale before anybody else gets a chance to take a look at it. Mm-hmm. In our position, we're very fortunate that we've been at this for a little while. So we have facilities in many, many markets. And so those are the markets that we're doubling down on, doing more marketing to try to get economies of scale so that we can spread our regional managers across those facilities and different assets within that market. But also, we also have an advantage in that we have this consulting company and our education company where we have a lot of other folks that are also sending out mailers and creating those relationships and looking to take down some projects, and they may bring us into those or wholesale those to us as well. So that's maybe a topic for a different conversation, but those that are looking to get into the business, start with a 2-hour radius of your own home and start sending the mailers out, create the relationships with the brokers, the business brokers, and then pulling on doors, beating the streets, and looking at facilities and talking to the folks that are inside behind the counter.
100%.
So self-storage is something that it intrigued me early on. I literally know nothing. We had one very good investor of ours that used to tell us, it's population, right? And if you're right on the outskirts and there's no population, it doesn't work. But from it, and I heard you just say, you have to, get out there, do the due diligence. Where do they go wrong from a due diligence perspective, or from a first-time listening, thinking that self-storage is what they're, what are, 3 bullet points on due diligence where deals can go really south if you don't uncover it?
Yeah. Well, here's the easy one. How about no due diligence? There's a lot of folks that, they get excited. And again, we always say, don't trust the broker's numbers. It doesn't mean you don't trust a broker. So for all the brokers out there, don't get up in a tizzy, but it means that brokers' numbers are only as good as the numbers they get from the seller. So when you see a listing and you've got a P&L or perhaps even just some raw numbers from a broker's listing, once you get it under get as much information you can as you can prior to going under contract or writing a letter of intent. But once you get into due diligence, yeah, it's backing into the P&L and everything, all income sources and all expense items. And, we have a checklist to make sure that we've dotted our I's and crossed our T's. And so just because something isn't listed on the profit and loss or even on the offering memorandum, and they leave out management fees and lawn care, landscaping, or snow removal, depending on what part of the country, doesn't mean that it's not an expense of the facility. Seller may say, well, my manager mows the lawn and I handle this and that, or I handle all the bookkeeping, or I do all the management, and that's built in. And our statement is always, well, great. If you're going to mow the lawn and manage it and handle everything else for us when we buy it, then for free, then that's great. But these are the expenses of the property. So just making sure that you're doing your due diligence. And then beyond that, I think also pretty simple, but we've seen this happen over and over, and you guys probably have as well, is that people get just so excited about getting into a deal. They've told their friends, their family, they made a pact with themselves that I'm going to get my first self-storage facility within 6 months or this year or whatever that looks like. And then come October, they're looking around the landscape or they're looking around their desk and they don't really have anything that looks promising. But you know what? Well, to meet my goal, and so as not to, look shameful to my friends and family and everybody I told I was going to get into the business, I'll take this one and I'll just get one under my belt and I'll make it up on the next one. And I think that is where a lot of folks make a mistake, is they let the excitement of doing a deal or, their goals get in the way of, doing the due diligence and making sure that the deal is the right deal and still fits their business plan and matches the criteria, their acquisition criteria, and that the thing is going to survive. Then getting into maybe the nitty gritty of the due diligence, I think it's, not necessarily, well, even the appraisal standpoint from an existing facility, we get an appraisal back, and many times it doesn't. I shouldn't say many times, but sometimes it doesn't match the purchase price, and it becomes lower. And it isn't always just a conservative appraiser. It means that you probably should look at the numbers in here and look at what they're comparing it to around the rest of the market. And if you're struggling to get that appraisal now, you're probably going to struggle getting the appraisal on the back end when you're looking to exit and sell it. So maybe you shouldn't buy this, and or talk to the bank about whether this makes sense to do this project or not. So without getting into the finer details, I think those are probably the three best bullet points that are kind of all encompassing.
Mm-hmm. What does the financing world look like? Like, I know bigger multifamily is easier than a 20 unit, right? There's different banks for different, appetites. Mm-hmm. Where does financing get really good in the self-storage world, and or where, is there a recourse component, or where does it get, not as attractive?
Yeah. So existing facilities that have a strong, historical track record of solid occupancy, or at least trending in the right direction, is real favorable to community banks, credit unions, savings and loans. Again, pointing to these individual facilities that folks may be looking at in their own market, anywhere from 500,000, maybe a little bit lower, on up to $2 million. And those small community banks, credit unions, savings and loans, they absolutely love self-storage, especially heading into a recession, because it benefits the most. Self-storage has the lowest loan default rate and lowest loan loss rate of all commercial asset classes. So when we start to sniff that we're heading towards a recession, those banks are clamoring to get every loan that they possibly can on self-storage to weather the storm. So very, very favorable from that standpoint. And then also the SBA has a 504 and 7A loans that are available for self-storage, and you can layer those one on top of another, and they'll go up to 90% LTV. And they only do that for self-storage because they consider that it a business as well as real estate. So from that standpoint, the SBA, everybody knows it's very easy to get into. Well, let me take a step back. Easier from an underwriting standpoint to get into. They will take folks that their credit may be a little damaged. You can obviously get in with less cash, less experience, because their goal is to get money out into the street. So that is the number one go-to source for self-storage. And quite honestly, also a reason why people looking to get into commercial real estate are looking to self-storage, because the lending is very favorable. It's much simpler and much easier to get into a self-storage facility and for less money down and with damaged credit than it is any other asset class, because the lenders absolutely love the asset class.
Mhm.
No, makes sense.
And then how do you look at deals? Typical multifamily is, let's say value add, right? Like come in, renovate
Mhm.
units, raise rents, stuff like that. How do you
Mhm.
guys look to increase your income, decrease expenses, increase your NOI, increase the value, and eventually exit or refinance, whatever liquidity event you guys look for?
hmm Well, first of all, we don't look at anything that is at 90% occupancy and rates are at the top of the market and it's managed extremely well with very little upside. Period. I think that's where people get in trouble. First of all, and anything that we look at has to be a value add. So, how do you do a value add in self storage? Well, we look for the mismanaged facilities that, you can tell distressed real estate is distressed real estate. Somebody doesn't know what they're doing and therefore it's a distressed, or, they just took their hands off the wheel and they're not managing it very well any longer. And they don't have a website or they don't know how to use it and or market the facility. They haven't raised rates in 8 years because they want to stay full, and they're proud of that fact, like many of the folks that we looked at in multifamily as well, and which is music to my ears and yours as well, because that just means that there's nothing but room to go up and rent. So, any ways that we can look at increasing rent to begin with. Then reducing expenses. Of course, there's tax strategies on the front end, since self-storage is considered in many instances in circles of business that also incorporates real estate. We come in with 2 purchase agreements so that we can then either keep the taxes where they are and pay the same amount for the real estate, or give us the potential to be able to appeal so that it doesn't trigger a reassessment. We also have the ability to do cost segregation, and we get about 50% back versus 30% that we had in our multifamily facilities. So from that standpoint, we get immediate value going into it. And then the use of technology. The game is won in the storage business with this right here. People don't want to come into an office and rent a storage unit any more than they want to come into Starbucks and pick out their coffee, or go into, and we don't have them anymore, a Blockbuster store to rent a movie. It's all done online, and we can rent a unit from a cell phone. If somebody's looking to rent a storage unit, they're going to look on a cell phone. What's closest? Can I get to their website? Can I reserve a unit or rent a unit on their phone? This is a commodity. They're not going to go and visit this site. They're not going to go walk into a rental office like they would in an apartment community and, meet with the person, take a tour, look at the layouts, talk about the neighbors, talk about the schools. This is a place for their stuff, and they want it to be close to home. They want it to be safe, secure, and affordable. And that's it. They want to check this off the box. And so, to the extent that a facility doesn't have the ability by way of technology to do that, then they probably got somebody sitting behind the counter at $12, $13 an hour, or the sister-in-law who could never find a job at $40,000 a year because it's a charity. So there's many ways through technology that we can come in and reduce the expenses in a storage facility. But then in terms of adding on the ancillary income streams, we can start, if they don't already, selling locks, boxes, and moving supplies with a small retail area set up in the office. We can add renter's insurance and get a commission for that, vending machines, boat and RV rental, and then the concierge services that go along with that, including detailing and propane filling. And there's we've got a list of about 40 different profit centers, record storage, shredding services, temperature controlled storage for wine, art, furs, other collectibles. 40 different profit centers that we can add to a self-storage facility that we can increase the NOI on. So we take a look at each facility, look at the market, what the demographics look like. Can we add those profit centers? But immediately, if we can raise rates and reduce expenses, those are the first 2 main areas. And then obviously expansion, that's the last, but the biggest. Can we add on additional units? Is there additional acre or half acre? Or, we can add the portable units. We can add 5 of them over in the corner because there's an easement and not have to build. Anywhere we can add more square footage, or buy the ground next door, behind it, or even across the street or a quarter mile down the road and use it as an annex if this facility is full and there's demand, and then run it as one facility.
And how easy is that process of adding additional units? I know you said the easement, where it just sounds like you just plop things on and they're not going to back into you, but going through, I'm sure, some sort of, zoning permitting process, do you find that that's usually a fairly easy process, or is it still fairly restrictive? Like I know, a lot of times building apartments, people have trouble depending upon what state or city they're in. What's your experience been like?
Yeah. So, well, that answer is always it depends. And
Mhm.
if it's additional ground that we have on the site already, then it's a matter of permitting and just going through. They'll take a look at the renderings, the architectural, make sure that either matches and that they're good with that. So that's pretty easy. If we're buying land next door or behind it or across the street, if it's already zoned, again, same thing. If it's not zoned for storage, then getting a variance or permitted use. It could be in some instances a rubber stamp because that ground has been sitting for a while, or that building that we're looking to convert to storage, has been an eyesore, and the city wants it back on the tax roll and something done with it. And then the other end of that is same thing. The city is, they don't want them darn sheds in their backyard, and the neighbors don't want to look at them sheds. And then we may have a long road to hoe and a big remonstrance, and in some cases maybe not get it done, or have a higher expense of putting a split block wall around it to hide what it is behind this, so that the neighbors don't complain and that they don't have what they consider an eyesore in their neighborhood, and the front, the facade has to look a little bit nicer, and then we have to determine whether that looks better or not. So it's really all across the board, Chris. Just no different than really, I guess, any other development is. If there's a piece of ground or a building sitting there vacant, and if in our instance, if the apartment guys, the condo guys and gals, if they've all looked at this and took a pass, it's been sitting there for a while, then we're just kind of going to the city saying, well, what are you going to do with it? Especially if it's retail ain't coming back, guys. What do you want to do with this thing? And storage is usually the best bet, and also generates enough revenue. It's very low impact, low traffic, utilities and everything else. And it's many cases it's the right fit and the best fit for that use in terms of what it's going to be going forward.
The other thing too, you mentioned 40 different potential profit centers. I'm imagining you only choose a handful for each facility. Correct. Right? It's not. So how do you look at a facility and decide what things to put in? Because I'm sure for me, when you talk about some of the different things like the paper shredding and stuff, that sounds like a very a more management intensive thing. And how much does that really bring in, right? Like, I guess, how do you look at those different aspects versus dollars brought in, certain areas, things like that?
Well, yeah, I mean, you're heading in the right direction. And to answer what I think you're leading it to is that it's personnel. Are we going to run this facility unmanned? Meaning, is it going to be by way of a kiosk and or the phone and website, and that's going to generate the rentals at this site? And there's just going to be a regional manager that goes around and checks on the facility from time to time, empties the cash, the checks from the kiosk, and it just runs as is, renting units. And maybe we've got a kiosk that also sells locks, and that's it. So that's the first kind of demarcation point. Or if it's a larger facility and we're going to have a manager or a manager and assistant, so 1.5 employees, then we're going to add, and we have the ability to do so, then we're going to add a U-Haul truck rental center. We're going to add eBay services. We're going to have, temperature controlled services, and they're going to rent those out as well. And if there's boat and RV, and we can add a concierge and dictate what that looks like, and do some of the scheduling for that for them, then that's going to offset and make it a profit, offset the salary, and then make it a profit center for us. And so we kind of start there as to whether we decide to run manned or unmanned. And then beyond that, it is is it an area with a lot of professionals that are going to need record storage, with medical professionals and attorneys? Does that make sense to then carve out a piece of our facility for that? Is it a high demographic with a high end or median income, which is a little greater than most? And are they going to want wine storage and furs and art and other collectibles, or temperature controlled storage to begin with? Or is it all just necessary or just a need or a demand for non-temperature controlled or ambient temperature storage? We need to understand the market that we're going into, what the demands are, and then also looking at our competition. What are they offering? Do they offer any of these already? And if so, are they full? Is there a greater demand for it that we can add as well? So, the second wave or second phase of due diligence goes into effect when we're going to build or convert or buy a facility, as to what are those ancillary income streams that we can add that makes sense in this demographic.
And what's the divergent for the manned versus unmanned? Is it just the size of the facility? Is it location? How is there any specific thing that makes that decision for you, or it's case by case, really?
Like, case by case, but then also I think many folks are looking at their business model. Is this what they want to do, period? Do they want to have a mixture of, or is their goal to go out? We've got one of our friendly competitors in the markets. He's actually a gentleman who lives here in Indiana, and his company is in 7 states, and they've got approaching 10,000 units, and all of his facilities are unmanned. So no ancillary income streams, but no employees. So he doesn't like tenants, toilets, trash. He doesn't like employees. And he's okay with having occupancy that's just a little lower because there isn't that salesperson in the office that can answer the phone or can meet somebody. But he would rather have less headaches, the reduced payroll across all of his sites, and that's just the way that they, fewer moving pieces to the business. We look at facilities individually to determine whether it's going to be unmanned. And if it's a smaller facility that doesn't warrant having a manager that we could keep because the facility can only generate enough revenue to pay somebody for 10 hours or 15 hours a week. Well, that doesn't make a lot of sense. So it's going to be unmanned. Larger facilities, a little more difficult to run unmanned, although we're heading that direction as an industry. But that's a place where we'll not only want to have a person in there to fill it up, but also to then take advantage of a lot of units, 1,000 units in there, which means a whole lot of opportunity to rent trucks and offer those eBay services and record storage and shredding services and everything else. So it is a case by case basis.
Mm-hmm. And you mentioned earlier too, that 6 to 8 per person,
square foot per capita.
Yeah, square foot per capita.
Mm-hmm.
I got to imagine that with such a tight window, any new supply that comes online can throw that off very quickly. Does that affect you guys a lot? That as you're looking at deals, that you hear about new supply coming and it's going to push you over that edge, or is that kind of like getting bitten by a shark in the ocean? It's not really, it very rarely happens. It's just people's fear is bigger than the actual thing itself.
Yeah, I'm going to say it rarely happens, but maybe it's just a love bite by the shark in the ocean. Doesn't kill us. How's that?
Sure.
So we've got competition. If there's competition in the market already, and we're looking at a site, most developers are pretty smart, and they're going to come in and they're going to look at a 3 to 5 mile radius. They're going to use the same types of formulas that we do as well, and they're going to determine whether it's undersupplied or oversupplied. And if there's a large amount of supply in the market, they're not going to build anyways. Mm-hmm. So from that standpoint, they're not just going to build it because and hope that they fill up right next to another 100,000 square foot facility unless they can see the numbers and determine that it's going to make sense to do so. Mm-hmm. And even if it is right next door to ours per se, that usually means that there's a whole lot of excess demand in the market, and they just happen to beat us to the punch and bought the lot next door. And our rates and our occupancy may suffer a little bit while they're offering specials during the lease up, but eventually, 18 months later, 12 to 18 months later, they're going to reach equilibrium, and then we're going to rise. Rates are going to rise together. So it doesn't make us really nervous unless there's sometimes a rogue developer that ignores a feasibility study, ignores anything else, and is just going out and buying something. And even then, usually the city will kind of step in and take a look at whether they want to approve another one of these facilities, especially if it's across the street or nearby another facility, if there's a whole lot of them, because if they continue to allow these to come in and we're all competing with one another, and to the point where nobody's making money, well, then they're going to have a bunch of empty facilities, and a bunch of facilities are going back to the banks and off their tax roll. So there's a little bit of self-policing that goes on just by the competitors in the marketplace. But no, by and large, we like it when the REITs, the real estate investment trusts, come in, because if they're not already there, because they are super aggressive in their rate management, and they market for our market. So everything that they're blasting out to folks, they get a $1 move-in special. Well, when people start calling our facility or looking online, they're going to say, "Hey, I saw this $1 move-in special online or on TV. Are you still offering that?" And well, yes, we are. People are they're just looking for what is closest to them and what they can click on and call from their phone to reserve a unit. So we all benefit when the REITs come to town and blast the market with their advertising.
Mm-hmm. Gotcha. And then just kind of wrapping up here too, I know converting some of these big box retail and stuff into self-storage is a new trend. Mm-hmm. Have you guys looked at that at all? How do you feel about it? And then what other types of, conversion trends are you seeing?
Yeah. So we've been doing that for a number of years as retail continues its slow death. And obviously that was accelerated separated this past year as well. So there's a lot of vacant big boxes and also grocery stores and a number of different retail buildings and strip centers that we're looking at the anchors. We're in the process of, we've got 2 right now under contract that we are going to convert, and 2 that are currently being converted, and more on the horizon. And that's probably our of the business models, from buying an existing facility and expanding to developing from the ground up. Conversions are our favorite because the zoning is already in place, or a small variance. We got the shell already built. Even if we have to put a roof on it and we create a mezzanine and put an elevator in it, we're still half the time from getting open, getting certificate of occupancy than we are from a ground up development. And we're typically buying it, on the cheap, because it's an empty big box that somebody had to let go. And it's depreciated. It's older. And so we can get in for $5, $6, sometimes $10 a square foot less than new construction, and shorten the time frame by 9, 10, 11 months. So that is a business model that we like very well, and we are very actively pursuing those in the markets that we're already investing in, and have some others that we are considering right now. So the answer to your question, Chris, is that is a live and a very good business model for us.
Awesome. Love it. I think that's a great place to wrap up. So thank you so much, Scott, for coming on and sharing your knowledge and insights. If people want to learn more about you, follow you, connect with you, where can they do all that?
Yeah, best things for all things self-storage, and how to contact me is selfstorageinvesting.com. That's selfstorageinvesting.com, and email directly is scott@selfstorageinvesting.com.
Perfect. Guys, go check out the website. Go email him if you have any questions or want to connect with him. The website is Wealth of Knowledge. I was checking it out earlier. So thank you guys so much for listening to this episode of the podcast. If you are not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Scott, once again, thank you so much for coming on, bud. This is great.
Thanks, guys. My pleasure.
Cool.